The glass half full view of the world at the end of 2019 is still intact, but the bushfire tragedies, the coronavirus outbreak, and below average business confidence is challenging the outlook. An update on our view at the start of the new decade. The 20s kicked off with optimism that the global deceleration had turned the corner, with forecasts of global growth dipping to 3%, but edging higher to 3.5% through 2020. And the domestic outlook was consistent with the global recovery, thanks to a truce on the trade wars. Local data was also positive through January, with employment growth running at 2.1% year on year, comfortably ahead of population growth of 1.6%. The unemployment rate is down to 5.1% at year end. This good news, together with an uptick in the inflation rate and more gains for property markets, was enough to keep the RBA on hold for February. And their language is still stoically positive. But the Reserve Bank did admit that the impact of the bushfires and the coronavirus outbreak will weigh on domestic growth. Just how large this impact will be and how lasting is the unknown part of the equation. But a negative read for first quarter GDP can't be ruled out. Far less likely is 2 consecutive negative quarters, a recession. So, while the impact of the virus on China will be significant, and the combined impact with the fires will be very challenging for local tourism and other service exports, we do need to consider the recovery, not just the downturn. Similarly for housing, the downturn through 2018 was very unsettling, but the inevitable recovery shows the longer-term trend. The gains in Sydney and Melbourne are clear on this chart. But in January, every capital city was stronger, and regional property rose 0.7% for the month. Stronger property prices are one consequence of last year's RBA rate cuts, which will help to offset slower domestic demand. But another impact from the cuts was a lower Aussie dollar, which did recover back above 70 cents at year end, but is back around 67.5 cents now, having been hit by the prospect of China slowing as it tries to contain the virus. The lower Aussie dollar will continue to help, but as for its direction from here, we'll continue to respect 66.5 cents as a key support level, but the brief run above 70 cents over New Year's could be a portend for upside risks. So the 70 cent barrier is also a key trigger level to be monitored. The third beneficiary of these record low interest rates is stock markets, with our ASX 200 up over 18% last year, and further gains seen in January. So, having posted a record high of 7,100, you can see it's been a very impressive decade for stocks, even though ours have lagged the USA, especially the Nasdaq. The 20s are off to a roaring start, but increased volatility in equities and other markets is likely until the impact of coronavirus is more clear, including locally through tourism and consumer confidence in particular. And that's the market update from Leveraged.